And from today we just have a much more going on with the deal and the investment process, the deal assessment, and then the pitching at the end of the day. And as usual, we have been probably discussing the investment process. We have seen it twice already, so you have seen it in the pipeline funnel, and we discussed it slightly about the BAM tasks, how to do it. But right now, the investment process today will be what should be done, what will be the actual investment process looking like. And I also mentioned about a few words about pre-pitching process. So because the pitching is like in terms of Business Angels Network, we have done for the pipeline funnel, and I hope that you get it. But right now, I just want to go what documents are to be signed before we go to the pitch, because there's some documents that should be considered. I would just also go to the famous clauses, the legal clauses that I mentioned about 4 times yesterday, and always said that I will talk today. It's not this time. I will touch them and I will discuss them, and I also will go for a little bit about investments models, so how angels invest, whether it's why it's equity, why it's different opportunities for them. So basically, when we think about the pre-pitching process, there's very simple documentation, but what's something that should be done if you are having a success fee from the deals. Well, it's recommended strongly to have a service agreement with the company signed before pitch, because then it's like you know that you should be entitled to get the money. There will be no question to collect the success fee after all. And also you can be saying about the range of services. And again, this is like should be no acknowledgement that it's not a financial advisory services. Should not promise anything. You cannot promise the company they will be pitching, because in the process they might get to the pitch, but you cannot promise them. And especially if they do not pay fixed amount of money, just success fee, it's like kind of a line of interest, so that's not an issue. And usually they ask to sign NDA. The companies frequently ask to sign NDA. And NDA is non-disclosure agreement, of course, so it's like that you will keep the secret of the companies itself and for yourself. Well, the reasons to sign and reasons not to sign, because I have been very reluctant as a business angels network manager to sign investment deals. Out of very simple reason, my task is not to keep the information secret, but to follow them to our angels. So basically, I'm here to proceed with the information. And one of the aspects is that I mentioned yesterday, that's important to sign, for example, NDA agreements or NDA clauses with the angels, and then you can say that you have like a fixed line. So we have the angels that sign NDA, and you provide this to angels that have already signed an NDA. So you can somehow say, okay, I'm just taking the NDAs and going there. But basically, I know many networks are not signing NDAs. Why? Because up to the pitch level, we are not interested much into the secret technologies or aspects of the business. We're more looking for the business-wise team, financials, and the business opportunities, which are not secret. And sometimes if the company is insisting on NDAs, that this business, especially if this business model can be easily copied and so on, and that we want NDA, well, the question is, okay, and once you will hit the market and someone else, the competitors will see, well, this is like, will be a problem because you will not have a protection. So it's not a problem about the angels, because usually angels have much enough work to do and not enough time to copy your ideas. It's not the task of angels to copy your ideas and bring them to themselves. So this is like of course the companies are afraid, but we have to somehow build trust and say, okay, well, what are you afraid? If you're afraid about taking the project, well, it's so easy to take the project, perhaps you will not meet one of the business evaluations, so how to create a lasting competitive advantage. Yes, simple. If there is like you're afraid of angels, or you are not investment ready. If you are afraid to show your idea to angels, that they will steal your project, because well, some people are afraid of angels. You know your angels, and you know that they are not. They have much more attractive aspects. They run fully the business. Yeah, they can invest in the business, support them, but not to build the business from the scratch. Basically, there are reasons still to sign the NDA, and the reasons to sign the NDA are, for example, if the company is in a pre-IP protections. So if they not issue the patent protections law, it's good to sign the NDA, because then they can always, if someone say that this somehow go away, say, but it was protected, yes, and they just not be, and they will just make a presentation, then they will say this is not this protected, so we can still go with the procedure to patent procedure. So basically, this is one aspect, and well, once we have it, we had the company that was providing services to army, presenting, and they have a contract. They have in letter of intent with the army, and they will just very secret. So it has to be signed, and that was the only one time that it was signed not by us, but it was signed by the angels on the meeting. Yes, because there was like a very strong demand for this, so we just accepted. But usually, if it's NDA, it's still signed by the angel group, angel network, and then different aspects. But from my perspective, NDA somehow makes it more comfortable for the companies to freely speak. But as you will see in the pitch, we do not want technological insight how it works. Basically, angels want to have a box. We put something there, some procedures going inside, and we have a good product or service for the customer. So that's why we just don't insist on technology. Of course, if we go further with the term sheets and so on, yes, then we will need more information, and then will be NDA clause will be a part of the next contracts before investment agreement. So as we go through the pre-pitch, then after what's happening after the pitch. So basically, I just like to also say about the actual investment process in a very way that I have been taught by Bill Payne from one of the mega angels from States. So basically, the investment process is a very selective. As you know, we're going from a few 100 to a few, and we have to limit through that. Even from a pitch, yes, we still have perhaps one in a three will be invested. It's lasting, so we have much time to know each other, and we'll take some aspects. It's demanding. Well, we expect a lot of information. We will expect a lot of data, and it's potentially conflictual because, well, yeah, it is. Yeah, we are somehow on a different. We are discussing it from a different perspective. And as Bill Payne says, it's very similar, in fact, the investment process to marriage. Yeah? To processing to marriage. The only difference, and the main difference, is that this is marriage but with a divorce plan. So we already know that the exit is happening. But this is always now, well, the one aspect about the investment process. Two aspects about the investment process that are important. One, the investment process we are just discussing mostly in the trainings, and today will be also the same, are focused on the preparation of the deal to the signing of the deal. But the investment process, in fact, this is like the first step of the investment process. Then you have building the company and exiting the company. And once you exit the company, it's really end of the investment process. And the second aspect is very important for myself, from my perspective, and you consider the deal. Because sometimes if you meet the angels, and especially entrepreneurs, they are just feeling that they are just selling the business. Yeah? It's not a sell. You're not selling the business, you're not selling the car or your home, yes, any home. You're just, in fact, inviting a partner to be part of the business. So the difference is that if you sell the car, you sign the contract and you go away and you perhaps never meet again. Here, once you sign the contract, well, next day they will sit on your board of the management and you will start working with them on a daily basis or weekly basis. So this is just especially about the conflictual aspect, that you have to be careful and manage that. It's like very important, just the conflicts will not dominate at a certain time. Well, it's not important so far, but it was like a remark that Bill Payne was also thinking about as on the kind of the level of philosophy, I would say, that with the exited companies, when you plan the exit for the 5-7 years, and usually in an average in the United States it's like 5-7 years, he said it once day, well, for 7 years, so these companies having a divorce plan already involved last longer than average marriage. right now. So maybe this is the issue that we should already plan somehow to exit also the marriage, which I do not recommend. I think this is like a kind of a joke, but this is the US perspective aspect. Okay, so what do we start with? So as you know, as we discuss it again and again and again, so deal evaluation is the first element of process by angels. Yes, so they get the process, they get the pitch, they have a screening committee, they at a certain time can request business plans. This is basically exactly what they need to assess the business, all informations. And then, if you go further, let's say we don't discuss right now about the procedure evaluation, but then if the deal evaluation is passed, okay, then we go to angels commitment. So what are how many angels committing to the deal? Committing meaning how many of them would like to participate in the deal. And then, of course, this is bound role to follow the angels. How many guys do we have? Do we need any syndication? And one very important aspect of this is like I have been mentioning this 3 times again yesterday, but this is lead angel, the role of a lead angel. And basically, a lead angel is, his role will be to lead the deal. Yeah? So he takes the deal and he sometimes he being starting as sponsor of the deal. So he has the direct, in-depth business evaluations. He's managing this, looking at what we need. He managed due diligence. He not running the due diligence because due diligence is run by legals, but he also sometimes asks the people to do it. Well, he's basically responsible for negotiation of term sheet and investment agreement. This is, I believe, at the process by the time of the investment is one of the most important aspects. So he has got experience and he has a mandate from other investors to negotiate a given clauses, to negotiate a given transactions. So basically, just trying to avoid all angels contacting entrepreneur and also entrepreneur contacting directly all angels. He is just a point of contact. So he could be supported, of course, by angel group, by angel network, but he is basically the one who will be leading it. That's why he is leading this. And then, very frequently as it goes on, he is monitoring and supporting company afterwards. So he is like the point of he's a little bit like a fund manager. So he's supporting the company from there. He could run the process and also supporting it further on. The question is also very important, how to remunerate him. But this is also mentioned yesterday with the investment, with the legal aspect of the running business, how to remunerate lead business angels. How it's done? Well, usually it's not the cash because well, it's not the aspect, but somehow it's taken from venture that he could be linked with a little bit more profits. So if the company brings profits, he will be taking a small share of other angels' profits, just to keep him motivated to do. But very important aspect is business lead angel. It's not only a fund manager, meaning he's only managing and taking profits. He also needs to invest his own money, because otherwise he will not be. He will be just leading, not an angel. So he will be missing this aspect. So this is like very the important issue for business lead angel from my perspective. And then we have a business due diligence, business allocation, because still he will be asking about this like in-depth business evaluation. We really need to know the company, and this is the time that we spend a lot of with the companies, learning them, understanding the aspects, and trying to support them. And then having lead angels taken, and we have made decisions, and we have like initial commitments. Well, we go to the term sheet. We usually sign the term sheet, and there are two different. Basically, the term sheet, like I said, is non-binding investment contract. So we say we are interested in the investment. The company, let's have an initial agreement. How many percent? What will be the percentage and amount of value invested, amount of invested. But basically, there's like a question about short or full version of the investment of term sheet. Short version, well, you negotiate it quickly. It's like the biggest aspect. So you go to the company and say, okay, guys, you need 1 million. Let's say you want to give us 35%. Let's assume it's 40%. We sign the deal, and we go and we proceed further. Yes, it's a very quickly. That's why it could be 1 to 2 pages done. So this parties, amount invested, share to be taken, and then that's it. But basically, on my perspective, I'm just very much for the full version, because full version is like a short version of investment contract. So you know all the rules. You will be you'll be presenting to the company all rights and obligations that you would like the company to have, or you have the rights. Why I recommend this at the time? Because later on, when you sit about investment agreement and you have already invested in the due diligence and you have invested a lot of time checking the business, and then you have said, okay, but we do not agree for the drag along, or we do not agree to these different aspects, then you're already almost close to the signing, but still there's an aspect that will be renegotiated and might make the deal endanger the deal. So my aspect is it's better to go for a full version. It's meaning with all these famous clauses involved, saying about the drugs, tax, liquidity preferences, vesting perhaps, and so on. So this is like very recommended. And angels, in fact, in 2008, when I was just asking them, in 2008 it was like they were moving from the short version to long version. Right now, most of the angels are rather for the full version, involving a lot of aspects of this. So they just exactly know that they will make the deal, because then, of course, the plus of it is like you go to the investment agreement, you go to the legals and say, okay, so we have an agreement, and right now let's proceed with the agreement. Please prepare the agreement on the basis of a term sheet that it's ready, and it's make it simpler. What else should be in term sheet? Well, basically we asked for the exclusivity. So in the meantime, the company will not look for any other investors, because, well, I know they need investors. We have committed to them, and basically we will start after signing the term sheet, saying we want the deal. Yes, we have we have like non-binding but still investment contract, and we negotiating with good faith to finance you. But in the meantime, please do not look for the other capital, because, well, we will manage this, and otherwise it will be so. And it happened to me before term sheet, luckily, but I have the situation that we have negotiated with a company, with a business task, and they were just looking still. We haven't signed with them, so it was on one side it was fair, but they were just starting looking for different funds, and it was like they were calling me every second day and said, okay, so we have a better offer. What would you bid the offer? Well, and at certain time I said, no, it's like our rules, we have agreed something. If you're just trying to improve the offer because you have someone better, go there. And go there and take the offer. But remember, ask always about, it's kind of the play, but ask if they provide you with the same value added. It's not only about the valuation, but also what you get instead. But we said we don't want to somehow, to make a bidding, because like it's always then problematic at the later stage, because then they would find at the final stage someone who will give them 1% better offer. As I signed prior to the due diligence. Well, of course, it's like not must, but I say if due diligence, you start due diligence, you want to know that you have agreement with the contract, with the people. Because if you don't have an agreement, you will not run the due diligence. You will not go for the due diligence in terms of cost, basically, legal cost.
Time and money.
Sorry?
Time and money.
Time and money. Yeah, that's correct. And my perspective is, if you have, and this could be a role of Business Angels Network as well, is to provide of a good template, because at the time of negotiating term sheet, it's really no need to involve attorneys. Because basically, if you have the contract, you can explain them to the company and just make agreement, and then only at the time of investment agreement you will just give it to the attorneys. Also, cost, money, and a little bit time protection. What would be the bond role here? Of course, facilitation in a deadlock situation, but very important, and then I will just put it still, explanation of difficult clauses. Basically, what's important for me, and I would say very important for the, and I love experience. How did I experience angels run the negotiation of the term sheet? They sit with the company, the founders, and they will not give them a single page of paper, but they discuss them what rights they need in a plain, understandable language. Because usually then they will put it on the, especially the attorney put this in the language, and I have seen the deals that people just was sending the investment agreement by legals, and they read through and they said, this is not what we have agreed. Then they called us as a band and said, we are afraid they're just going to take us the company. And basically, if you sit down and explain first to them why such clauses are involved, it's much easier to make them understand this. And this is like, well, very important from my perspective. Okay. And due diligence, yes, due diligence and legal due diligence, everything about investment process will run and a few aspects, yes. One aspect is a corporate governance. So here we have it checking articles of associations, shareholders agreements. We will be asking about, as mentioned yesterday, 4F involvement. If there are any involvement, and yes, what form? Usually, and it's like a standard form, that most, or if not all, of the business, of the early stage companies have a mess here. They didn't know, for example, that this should be signed by notary, or they just haven't signed it properly, or something else, and it's really, a mess on the mess on the mess. And it's like sometimes, if the company is like 1 year old, it already has a lot of papers to correct. And it's just our task. There are two reasons why we should correct. Because basically on the investment process, it's not a big problem for us. But we need a clear situation. Also because we believe in the next 2-3 years we'll be going for the next round, and venture funds will check, and they will prefer to have it clean and ready. That it's like a really neat documentation. It's not again going through the full due diligence, asking why 3 years ago you have not signed this, or 5 years ago you forget about this loan. And this is like basically what's done. But also the contract issues, we usually check the key customers, providers, and investors. Well, with the providers and about IP, there's like a very difficult aspect in the law, and there's like people go there. For example, you meet with the logo designer. Yeah, you pay for the logo. He provides you logo, and there is like a number of aspects. If you can use the logo, but can you amend this logo? Do you have a full rights to the logo, and so on and so on. That's like we always have a mess with this on the business level, because sometimes it was a friend of the founder was just running the company, and then we have writing a number of annexes to the deals that we have done. We're also taking the taxes. Basically, we are checking if you have no tax due taxes. Sometimes, if yes, we can invest. Angels can invest in that companies for the due taxes, but we know why they have due taxes. What's the reason for this? We're checking key assets. Usually, that's a good point for this. We do not have a key assets like real estate and so on. So there will be no mess behind us, because founders usually have only an empty company. They're just trying to build an assets base. And if there's any lawsuits, and sometimes it's happened, they have already, or they just, sometimes they are fighting with founders, they split it, yes? So the question is who has the rights, who has the obligations to do what. So it's really potentially, it's not frequent, but it could be dangerous for us. And then of course, IP aspect, which is completely different, especially in tech companies. Well, we have to run the IP tests. I mean, if the patents has been issued properly, it's easy to ask to do it. But the question is also, and this is not it's not about proper aspects, but when they were issued. Because usually, in most cases, the people are just going to the national, or maybe right now European Patent Office, and they registered especially in Poland. For example, you register like you pay €100, and you can register this in Poland. But if you're thinking about investing in a potentially global company, well, you have a limited time to make patent applications to the other countries, and if you miss it, well, basically you're protected like in Poland or in Germany or in Greece, and that's it. Yes, and in the different countries, they can use your technology, they can copy it, and you have no protection from this last side. So it's also an important aspect. But the question about ownership of the IP, it's all what would be wrong with the ownership? Well, the question is, who is the owner of the IP? Is it the company or is it founder? Because we do not invest in companies when the founder will not move the ownership to the company. It has to be based on the company, because this will be main asset of the company within the next few years. The issue about patentability. not everything is patentable. And it's clear. And many companies do not have a patent product. It's not bad. Coca-Cola is not patented, it's one of the famous stuff. And you have a lot of business that we do not intend to patent, but then it's the question how you're going to protect your IP. You have different aspects. You can, of course, like a company secret, know-how, different aspects, but basically you have to know if their IP will be somehow protected, if not by patent. Right now, also, for example, you cannot the software. So in Europe, you cannot go for the application for patents. You can make algorithms somehow patented, but not the software itself. So it's like really difficult. And the other case is like with this software, with the patents, they last really, really long. You can put the in most cases when you start discussing with the startups, and we have a patent, and said you have a patent or patent application. Because two different aspects of this, and there are basically with terms of IP, there are specialized attorneys, the IP attorneys that can check this and say whether it's okay. You can also, for example, about patentability, if you want to patent the product, well, you can run. It's also costs a little bit, but it's like it just could be a crucial point. You can check whether there's like a there's no, you can say about novelty, check novelty, so it's like you go into the screening and they say, okay, so it's like really novelty, so you can have an AA grade of this, and about kind of we can also discuss the patent strategy. It would be umbrella patents, somehow it would be, are there any patents that could be potentially, you'll be going in conflict, so it's really, really number of issues that you should go, and there are specialized patents attorney that I basically would like to say use it if it's important to have it, because it's if IP is important, then every penny spent on the IP protection is a must. And then going to what you're based on. Well, basically it's a data room. What we need in the data room, there will be official documents. Usually that's council right now enough. And this we're coming back also to what I mentioned, reps and royalties. So basically, at the end of the due diligence process, the attorney said, okay, so to the founders, let's sign that you have provided us all documents you have. Yeah. And if there will be any other documents, you will be personally and barely responsible for what you have forgot to include to the papers. And about BAM role. It will be to educate entrepreneurs, for example, about data room, because sometimes to prepare data room, well, it lasts 2 weeks. So it's, if you know that going to for a due diligence before, you can sit with the company and say, okay, this is like a template of list of documents what could be needed, because usually attorneys can provide you with a template list, and they can start preparing the documents, scanning them, looking for them, considering if they have or not. So basically, this is like good to have. Sorry? Checklist. Yeah, the template is, yeah, it just has articles of associations, contracts, and I know that it's usually not in one place, yeah, usually somewhere.
Everywhere.
Yeah, everywhere. Where I put it, yeah, just, I think I had it, yeah, I have, I don't know, yes, it's a frequent problem, yes, with these guys, and it's like really important. And of course, press companies provide documents timely, because if you start the due diligence, well, they are of course due diligence is also from the company perspective. All the process is like taking them from growing the business, because they have to keep focus for negotiations and business evaluation and due diligence, and they just slightly going. At least CEO, there should be kind of division, but CEO should be more focused on the investor relationship at the time, and he's not fully focused on the business. But well, if you start doing time, because all angels and yourself and the company need usually the timing is crucial. So just ask them and stand on them and say, come on, when you will find it. If you don't, and basically, if they don't have it, make them sure they say, we don't have it. Yeah? We do not have this agreement. Yes, we just make this. We just haven't agreed on the napkin, and the napkin is lost or something like this, and then we just think about different structure to do it. But there's one more due diligence I haven't talked before, and I even mentioned. But this is the due diligence that also, as a ban, I would suggest that you should recommend to entrepreneurs. Because entrepreneurs should check investors as well. Who is going to invest? Because, as mentioned, this is kind of a marriage style of a partnership. So if it's going this, I would expect the angels also to be open to tell about the portfolio companies, investment strategies, how they are going to involve in the business. It will be a hands-on or just, well, basically you can have, involvement will be hands-on, meaning really we meet on a weekly basis, we discuss, we just try to support you, or it could be more hands-on. Sometimes it's like, okay, so if you have any problem, just call me and I will just try to support you. A different aspect, yes? Which, let's say, what can we do? What are the backgrounds? Where we can support them? And basically, they also recommend somehow the entrepreneurs that they will ask angels about different companies they have invested to let them contact. Let's see how you cooperate with the business angels. I believe that the transparency of the process, if it's fair, if people, there's possibility, even if there's no, of course, they're not always all the time the good aspect that we are running, but they are, and the references are the best one. Well, basically, it was like we had in a fund project that we've been really digging in for some time. And making, business evaluation, terms negotiations, and completely suddenly, one of our friends, Angel, sent us the list of the deals that he had been involved in, and he mentioned the company that we have been investing in. And then was the question because, well, he put the company, and it was like a company and exit, yes, and it was like the name of the company that I will not tell, and there was like a founder fraud. And we said, well, come on, what do you mean fraud? And so we just made the references, and really the references are a crucial point from both sides. It's turned out that the company is like raising money again and again and again, but we have already in our organization an angel that failed with the company. Because he put the money and just make a negative output out of it, because the founder was just not being fair with him. So, but they also here with the angels, well, you usually know your angels, and you know they are just angels, not dragons. So the more there is no reason for them to hide and do not show, or do not contact, for example, with some portfolio companies they own. And then after due diligence, we are moving to the investment agreement. So then we have the final terms and conditions negotiated. It's really the investment agreement. You have to be, well, my legals spend about 2 weeks to prepare it, and then we spend next 3 weeks to negotiate with but it's more fun aspects, and the legals are pretty aggressive, I would say. That sometimes, I say, okay guys, take it easy, yeah? It's a venture, I accept the risk. Yeah, I know that you have to say, I accept the risk, because also attorneys they have to protect their customers, and sometimes they understand that this is like venture business, and sometimes they do not. So sometimes you have to say, okay, it's push down. Reps and warranties, yes, I would say really, really important aspect of the deal, just to protect yourself. If there's anything missing information, or misleading information, or some not true information, well, you should be protected about this. If there's great examples are, for example, family or some debts. Yeah, the company has already loaned, and it's not has not been shown in the due diligence, because we are not checking, we are checking kind of the due diligence more in a red flag situation. So what are the problems? Yeah? If you have not signed the founder has not shown any contract, due diligence, any debt contract, loan contract, well, how should you know the rest of that? And if next day after investor someone will show up and say, well, I have 100,000 to collect because this is my time, I'll say, okay, go and ask the founder, because the company will not pay to you, because this is like the founder's responsibility. Or in fact, if the company will pay, the founder will pay back to the company. It's simple, but it's important. And all the conditions precedent, which is like the list of things. Okay, so we sign the contract. It's already binding, but you have to fill a little bit more tasks before we put the money. Usually there are sometimes you say, okay, so you have to issue patent application, yes, before we go in with the investments. Or basically there are more technical aspects, like we have to amend articles of associations. Because now there is asked to have articles of associations and investment agreement and shareholder agreement sometimes. What's the difference? The difference is that articles of associations, and I will talk on the basis of Polish law, but it's more or less similar. It's like a kind of act that is constitute the company. But this act is going to be brought to the court and it's registered. And in Poland, for example, if the legals can have an access to this. So you don't want to put too much details in the contract about it. But also what's important, if you have an investment agreement set on rights, and you say, for example, that the founder cannot sell his or her shares to someone else before year 3, and this is an investment agreement, this is like a contractual obligation. But if you have an articles of associations, which means contractual, so if he will say, if you have only an investment agreement, and he sells the shares, then you can go to them and say, okay, you have to pay it back to me because I lost something and all the procedures going on, that he should not sell it. But if it's written in articles of associations that within 3 years founders cannot sell the shares, then the sale of shares is basically ineffective in law. And then the company said, well, you can go to the new buyer and say, sorry guys, but this is not valid because this is like, you can go to the founder and argue with founder, but he could not sell you and you cannot buy it. So that's why the articles of associations are stronger because they are binding the company, the rules of the company. And also sometimes we're taking the POAs, especially we have like a drag along or a tag along rights. So we have a POA, which means power of attorney, that we can do something on the behalf of the founder in certain given case, of course. But this is like an important aspect to have it, and it's very practical to have it at a certain time. And of course, then with the sign, after the signing, we also go to the closing. Yes, which is like different aspects of the signing and closing. Signing is the day you sign the agreements. Closing, for example, before you put the money to the company, they should increase the capital. So they should call the shareholder meeting, still without us, because we are not the shareholders, increase the capital, offer the shares to us, and we are taking up these shares, which you finally pay for, and this is like the moment of closing. Yeah? The investment, the bank has the right to go for the success fee for the tranche trade. So basically, it's like a lot of process to do, a lot of papers, and basically signing an investment agreement, signing and closing. It's legal aspects, a lot of legal aspects, especially if we have well-negotiated term sheet, so the legal should be very supportive at this stage to do. And then, as I mentioned, it's like, having an investment in portfolio is like still kind of the investment process. So what's your hands-on approach, how you can support the business. Will you be a board member, usually non-executive, because it's like limiting your responsibilities. The way you monitor the business, it also could be supportive of angel group, for example, to provide some templates or aspect how to support it. Well, basically the two last are very important. Attracting next rounds. It could be kind of a crucial for me to be able to attract the new rounds by the angels. And also lead exit, because the exit, as mentioned, usually angels have more experience, better contacts, and much more motivation to exit. Because with the founders, usually there's kind of feeling, the company will grow better. It's not the best time to sell. Not always. Sometimes it's time to exit. Yeah, it's time to exit, and you can make money. And that's always difficult. And now we will go to the two aspects, investment models, but first, the famous, which I have prepared, the key clause. The clause that makes people, makes entrepreneur nervous, and on the other hand, makes the angel, it's very important for angel. Of course, there are more of them, but these are the ones that usually creates most of the tension during the negotiation. So, what's lockup? And with lockup, we say, guys, we're investing with you, but of no reason, of course, we can agree on this. This is always contractual, so if everybody will agree, so you can change it. But basically, you are not entitled to sell your shares within the next 2 years or 3 years. Now, we're investing in you, and we want you on board. You don't even think about exiting. And this is kind of an easy task, and it's like no question. The other aspect is liquidation preference. Liquidation preference means.
Excuse me, can you repeat lockup?
Okay, lockup. So basically, in the sentence, the founders cannot sell the shares.
Okay.
they're just locked in the company for good. The next aspect is liquidation preference. Liquidation preference means by the exit time, as we have put a cash and you have put some kind of sweat equity, so you just your work, your experience, your time, but we put a real live cash. So by the exit, we are first to receive our cash back, and only once we receive the cash, we are going to divide the rest according to the percentage of shares. So it is like we have a kind of a liquidative preference. We have a protection of our capital, a little bit of protection, of course, if we manage to sell the company at the price. And it's usually not a problem to have it with the angels, with the founders. The question is how aggressive we will be with the liquidation preference, because there are potential aggressiveness on the angel side. For example, say 3 times liquidation preference. I mean, at least if we invest 100, so we need to get 3,000 back, and only then we just start 300. Only then we start splitting the remaining. Yeah? So there's like different aspects. Usually, liquidation preference 1 is fair enough. We just protect our capital. Yes. And then we go for more difficult anti-ratchet clause, or even ratchet clause, so anti-dilution clauses. These are the clauses that are valid for in case of the next rounds. So we say, we have a plan, we today invest here, at the company valuation, let's say, of 100, and we believe we have the next rounds of about 120 or 100, 200 or maybe 1,000, just increasing the valuation. But if anything happens and the valuation will drop, so it will show that we have misvalued the business today. So we want the valuation to be drawn back to the prices that you will be, if the price is lower, we want to have more shares to basically have the same valuation than your new investors. Well, at the day of investment negotiations, usually does not make a problem for the angels, for the founders. It's slightly more problematic when it goes to the next rounds, and it's appeared that the next rounds dilute the founders, but we also dilute the founders again. And always there's the issue about how strongly they will be diluted, because if they're diluted too much, well, they lose motivation to work. But this is kind of the strategy to say, for example, how it's going. The simplest way we say, okay, so you have to sell us some shares that we will have an average, sell us for example, 1 cent, that our average price of the share will be exactly the same as a new investor. And then we're going about vesting. Well, vesting or reverse vesting, there are 2 aspects of this. Reverse vesting, and basically we say, usually we use a reverse vesting scheme. So we say that the founder, let's say, has 40 shares, 40% shares. I mean, let's say there are 2 founders, one has 40, second has 20, and we have a share of 20%. But let's say constantly focus on this one. And let's say this founder has 40 shares, which like 30% shares, with like 400 shares in a number. Basically, on the cap table, you will see that the shareholder 1 or founder 1 has like 400 shares, which constitute the 40 shares. Then, very important aspect is we say, okay, guys, I know that you have lockup, but you can always leave the company. It can happen that you will say, well, I have better things to do, I have better idea. So we say, if you will leave the company, we will take some of your shares. You will just give the shares back because you're not running the business any longer. So why should you have the business? And vesting says, for example, you usually say, let's say, it's like a 4-year vesting with a 2-year cliff. What does it mean? It means that we say that basically we take time of investment, we have investment time here, and we have 4 years. And after 4 years, whatever will happen after 4 years, if he will leave here, well, he will still have 400 shares to own. He will own. But if he will leave earlier, then the question is when he will leave. Because if we say, for example, 2-year cliff or 1-year cliff, somewhere here, and we have a cliff. So up to this moment, he will have, once he will leave, he will got 0 shares. The cliff means up to this moment, you take no share. You are not entitled to any share at all. That's zero. And from then, for example, he got back to the 50%. So he will already have 200. If he will leave in the month 24, he has 200, and then it's linearly growing to 400 at year 4. Well, it's difficult for founders sometimes to understand, but it's working well because they are just sitting in the company. It's not about selling his shares, because sharing his shares is like a lockup. We already have a lockup with this, but this is about once he will leave or once he will find something else to do, that he will not be involved in the cap table. Difficult, but with most founders, you can explain them why it's reason. Because well, if you will leave here, well, basically you will need someone else to work for you, to do the work, and we need the shares for him. I will not dilute myself as an investor because you failed to do it. So we need fund this way. And my perspective, there is also other perspective I have, is the perspective from the group of founders. Because sometimes if you have founders, 3 or 4 founders, especially if you have more than 3, then the founders are living, some founders are living the business at a certain time. They have different ideas, they have like a quarrel, they just arguing each other, they do not work. And then the ones who work are just getting angry because they work, but the value of the work is also gained by those who left. So sometimes the lockup, we say the lockup is a good for the internal relations, not only for the relation with the investor, but also with them. If you leave, why should you keep the shares? It's not the company, it's not a stock exchange company that already has value. We are just building the value. And this is like, I have introduced it like recently, because I have right now 2 companies that have the problem that the founders has left, one of the founders has left, and they are just sitting and they're just making more troublesome situations, not supporting, but still they have the business is growing and they just have a share in the growing business. It's none of those who are just looking at this stage like it, so we're just trying to protect it this way. Then we have a tag along and drag along, and these are the typically venture style stuff that have been accepted in the angel market. A tag along is a very tag along, I would say, out of this rights is the easiest to accept. Tag along would be very easy to accept, and there's no discussion at all. Tag along means, well, in the moment you will find out the situation, there's a founder said, I want to sell my shares. Of course, there's lockup, but okay, the lockup is finished, and he wants to sell his shares. You have there as an investor say, okay, guys, I have invested in a team, and I want to have a right that I will be joining your sales. So if you're going to sell it to someone else, I need a right that I will be entitled to sell the shares at the same conditions you have. Simple, because I do not want to stay in the ship when the captain has left. Of course, the question is that there's some details in it, but basically, founders said, okay, it is fully understandable. We leave, you have to, we are giving you the right to live at the same aspects. Sorry, I'm just coming back. And then we go to drag along. And drag along is kind of the situation that is, we spend most of the time negotiating, and they're just always saying, they want my company, they want to take my company, yes? They want to steal my company. What's drag? It's the right of the investor to force founder to sell his shares to a third party. How does it work and why is it important? Basically, it's about the exit management. This is the case if the company is not really, the founder is not really eager to sell the company. And as we discussed, the number of IPOs is dropping and the number of mergers and acquisitions is growing. And very often you think about strategic buyer. Strategic buyer says, I want it all. I do not want a half of the company. I want a full company on. And that's the problem. The discussion with the founders, well, but I want to stay in the company. And sometimes, well, I have encountered one of my angel, I have encountered a situation that there was, he owned 40% of the company, and they were approached by a fund. It was a healthcare service company, and they were approached by fund, and the fund offered them 100 million zloty for like a full company. But they have a plan to implement this just they know, the fund know what to do. And it was a very successful exit, a potential exit. He should have like 40 million on his estate, but he doesn't have a drag on it. And the founder said, no, we are not going to sell. And of course, it was like kind of the discussion, because he realized the moment that he is stuck, and he has potentially 40 millions, and in real, he has shares. And he cannot buy anything with the shares because the fund said all or nothing. And it finished up that they didn't sell their fund. And 2 weeks later, the founders came to the guys and said, okay, we can buy your shares for 20 million. And he realized then that either he will sell this for 20 million or he will be really in a big trouble, still making good returns, but half of this was potential. But this is kind of, if you have a drag, you're not in this case. You are just protecting yourself that if you think about time to exit, the exit offer is fair, you will make an exit. Okay, so this is like investor approach. What are the founders' threats? Why they do not like the drag? Well, basically they say, and if the third party is somehow got controlled by the investor, and they will buy the company much lower below the price. Yeah, it's a fair point. Yes, of course it's happened really, but I understand it. At the time, they just start knowing each other. They don't know each other well. So what will be the how I just address the issue of the drag for the entrepreneurs? I made some call. I call it a softeners. So I said, okay, I stay with the drag because I have no options to get drag out of the equation, but we can discuss how to comfortably, that you will feel comfortable, and it's not kind of that protects our targets and still not endangers your business. So basically, one thing is, like, say, we can use drag only after some period of time, for example, 2-3 years. Well, the first 2-3 years is just a company to grow. You're not thinking about exit in 2 years, basically. So he said, my intentions are fair. I'm not going to use it. Then the second aspect, which is a little bit tricky, is about to renegotiate the minimum price of the exit. So, for example, we said, when the price cannot be less than a million or twice our investment or whatsoever. And then with angels it's easier, but in a fund, for example, we know that sometimes the sell is kind of the, you can sell it at the discounted price of write it fully, and write off it fully, meaning put it at zero at the assets. Because sometimes the companies are not growing, and that's why we are basically reluctant to put any price on the drag. But what is absolutely fair is to say, if to the founders, so if you want, you can buy the shares from us, or find someone who will buy the shares from us at the price that we offer. Because then if for example, I will find my third party offering half of the market price, go for the market, take a three months, because there's also discussion about how long, and I think that like 60-90 days is fair enough, because they need to find the investor, they need to find someone who will buy it. And if the investor will give me better offer, well, Angel will be selling to their counter offer, not to them. And it's like fair enough for funds, because they are just somehow saying, okay, so now we have a protection that if there will be kind of a fraud sale, we can get to the part. And this is fair. I believe that it's fair and it's working. And I really, basically, in funds term sheets, our investment agreements, we always have drugs. We always have a drug. We have no company without a drug right now. And it is like a standard. And much as it is difficult to understand, you can always ask the funders to make the research on the market or on the web and find how popular this drug. And it is popular, really. It's like a standard right now. So they should accept it. They also should give a little step back out of the comfort zone. Well, it's not longer the private company, it's like a fund company, and they also have to protect investor rights and investor things that are also...
Can I have a question?
Sure, of course.
What if there is a situation that
business angels would like to sell their shares, and the CEO instead of finding the investor who would buy the shares, is selling the company's shares. So he's like.
Instead of angels?
Instead of angels.
Well, then you have
the angels have some tool to...
First you have a lockups, and then you have a tag along, so you have a right to, you have basically right to sell your shares with founders. Sometimes founders ask that if you are selling your shares, as investors selling his shares, they also want to have a tag along. So they say we don't know what the investor will bring, so we would like to have a right to sell the shares with you. Fair enough, yes. Maybe I would say I would not put it in my term sheet initially, but if the founders will ask for it, well, I can trade it for something and I can accept it. Perhaps with a little bit more about to try. And of course, I'm not mentioning here kind of the statutory rights like right of first refusal or priority. So that usually that's the case that the current shareholders have the priority rights to buy, or right of first refusal to buy shares in terms of sale even. So if I'm selling the shares, well, basically if it's not excluded in Polish contract, Polish law, then the other shareholders are the first I need to offer them, and they have the right of first refusal, for example, in 40 days that they will buy. Yeah? It's always tricky, but it's like important to have. But basically, what also just asks sometimes on not it depends on discussion, but sometimes we put it in the contract. Sometimes I'm just more relaxed or but not really. It's about time commitments and engagement. Well, you want the founder to be fully engaged. It's like I know he's an entrepreneur and I know that he will have hundreds of ideas, but for the time being, he needs to focus on this particular one business where you are investing, or your angels are investing. So that's the case. He gets the money to run the business. Basically, it happens sometimes in my cases that I say, okay, you can run something else for the next 3 or 4 months just to steadily switch it off. Yeah? Sometimes it happens because there are some businesses that you still need it. But basically say, fully engaged in the business, this is your task to be. You get the money to do it properly. And then investment schemes, how to invest. Basically, angels prefer equity. So they get they get shares. In US, they also all try to get the preferred shares with the liquidation preference, sometimes with dividends rights in favor, and so on. And this is like preference. The problem with the equity is that you need the valuation. So you need to tell how many shares I will get how many number of shares I will get for this given amount of money I put, meaning also the percentage of the company I own, thus I know the valuation of the company. And this is like always making the discussion. The discussion always has to take place if you think about equity. Valuation will be a large part of a business evaluation, a business process. We just go, as it's a little bit my interest. I just dig in the evaluations, how to approach it. But you need to do it in the equity model. So, and then sometimes you cannot find the solution or different aspect of the problematic. Well, angels also invest in a convertible note scheme. What are convertible notes? So basically they say, we do not know how much the company will be, what's the real valuation of the company. We don't know it. So they agreed that they will put this as the debt, loan to the business, and say, we will value the company together in the next round. Basically, we say, if the venture company will come, well, they're more professional, the company will be more mature, and they will make the valuation. And then it's, of course, we said, okay, so angels usually accept the valuation of their venture funds, but there are 3 aspects they have to think about. First part is the minor aspects that I forget what it is about. If you put a loan, the loan should be with some interest, and usually the interest makes the accrual. So, for example, if you have a 5%, you put 100 and you have an interest rate of 5, So by the time of conversion, if the conversion happens in 1 year, you will be converting not 100 but 105 of dollars or euros or whatsoever to the shares. Then the key aspects that you should negotiate are two. First of all, is the valuation discount. Well, if the venture fund will come and say, well, the pre-money valuation is 5 million, and said, okay, today it's 5 million, but like 1 year ago, the company was in early stages, so I should get better valuation. And usually it's done by discount. So I say if angels go for any amount, I have 20-30% down of these amounts, and it's like fully executed by angels, by founders. That is like 20-30% less on this from the valuation. The company has grown, angels take more risk. All of the aspects are really valuable to say, okay, so we are going for better valuation, lower valuation. But there's always the issue about cap. What's cap? Cap is you set the maximum price of conversion. Why? Well, sometimes it happens that if you choose to take your business well, it can go not 5, for example, 105 million or 100. And then the cap says that, okay, well, the valuation is like 30% discount, but still the maximum conversion price is like 6, 7 or 8 million of dollars or euros or whatsoever. This makes you a comfortable zone. If the business is very successful, you will still own a little bit part, a larger part that will be served from simple discounts. Clear?
Not very clear to me, the last 2 points.
Last 2 points, okay. So basically, let's assume that investor says, we put 100 in convertible notes.
Mm-hmm.
Yes? We don't know how to convert this. I mean, we don't know the price. But we know that at a certain time, angels will come and say that we, for example, value the company for the 5 million euros.
Mm-hmm.
Well, the 5 million euro will also, this is like the whole company, and you can easily calculate how much each share is on, because you know how many shares have been issued. So it's a but basically, let's keep on this 5 million. But you can just divide it by the number of shares, you get the price per share. And then you said, okay, so my reference point, if the valuation discount is say, my reference point is always at least 20% less. So I will pay not, if it's 5 million, it will go to 4 million euro. And this will be my conversion price.
But then you're downgrading the company. Wow.
It's not really downgrading the company. Ventures are investing at discounts, at this valuation.
Yes.
You have invested a year ago, year before angels, and there is technically there is a reason to believe that the company was worth less a year ago than it's worth today. And you're just getting, because you take more risk, the company was early stages, and you have agreed with the founder that you will accept the price of a venture, but with your money you get something, so they will issue you a discount. It's not really downgrading the company, it's like giving yourself as an angel a little bit premium that you have been involved before venture capital fund.
Trust, you get kind of a sconto.
Not about trust, it's about taking risk.
Okay.
It's about taking risk. You have invested earlier, so you have already, if you put half a million on the table, or 100 on the table, well, the first company will not get to the point of the 5 million valuation without your money. That's one aspect. Two, well, there was like a risk. Still there was a like 50% risk that you will be zero valuation here. So you're just taking this risk, and you are just get a premium for that risk. Okay. And then it's like the price cap. So, for example, we have not 5 million. But you have 100 million, so that's 100 million. So even with discounts, you will go to 80 million valuation, which means that you will have like 1 share or something like this, based on the conversion rate. But before, because you have been discussing with Angel before, you said, okay guys, whatever will happen, let's assume that the business, that I have 20% discount, but the business will be worth no more than 8, the conversion price, not sorry, I'm just sorry. But the conversion price for me as an angel will be maximum 8 million. So if they will be though 10 million euro or higher, I will be always stick to the 8 million. This is fair because then you get your, then you get some, you know exactly the worst case and the worst and the best case scenario of the business. Yes, so you know how many shares you will own in the case of the company being very, very successful. So you just say, okay, I want to participate in the business well. And usually it's not a problem because no founders will come to you and say, well, let's value the business 10 million euro or higher. Well, it's nonsense because they just started here. So they accepted, for example, that today valuation, basically convertible notes are important best if, for example, if you have a dispute, if the company is worth 2 millions or let's say 6 millions. Yeah? And angels say, yeah, it's like more closer to the, angels will say closer to 2 millions and founders will say closer to 6 millions. And this is like the distance, the gap is too large to find a solution because it's not easy to say, okay, like make it 4 in the middle, yeah? None of you will be satisfied with this. So angels say, okay, I don't know what will be the price, you don't know what's the real value of the company, so let's assume that Ventures will do it for us. Yeah? In the next round, this is not a technical only counting valuation, but the angels come and put the money at the valuation, and you say, and I will accept whatever it will be, but because it's earlier, well, first of all, I will get 20% discount of the angel stake, and second of all, well, you have offered 6 million, so let's say 6 million is the maximum valuation for myself. If it will go any higher, I will still stick to the 6 million at the conversion price. So this is like these are the plus of the convertible note. That it's a little bit simpler, and you don't spend time to negotiate. The problem is that in case there will be no next round soon, you are sitting in convertible notes that are not easy to sell. Sometimes in convertible notes you can put that if the round is not closed within the next 2 years, then we stick to one of the price before that we will just make that you have the right to make the conversion. A plus of note is also as it is debt financing. In terms of a collapse of the business, you're first to get your money back. Before shareholders. But it's usually it's not a big plus because usually there's nothing to this kind of company. There's nothing left. All money has been used and there is not much wealth accumulated. So it's like only technical reason to believe, but not really practically. I wouldn't stay for it.
But according to your knowledge, what's the percentage for which investment models do the business angel goes? For like 60 to 40?
About convertible notes?
No, convertible notes compared to equity.
This is strange. Angels said, and 80% angels say they prefer equity. And we consider that 60% of angels doing convertible notes, at least once a year. But I think that it's like half a half, because it means that angels do more than one deal, and sometimes they just make a convertible note, sometimes make that. So I think that it's 50-50, and it's trending towards equity. A few years ago, there was like convertible note was pretty standard for US. Right now, angels are getting more and more like ventures. Yes, and just learning from ventures and just getting more to the equity. So this would say they just try to get the valuation done right at the beginning, which is not so difficult. So, I mean, of course, this is a difficult aspect. And there's the other aspect of the in angel investing. So you have the agreed the form, the equity, convertible note, the pricing, valuation, and there's a question: how do you invest? Yes, if you have an individual angels, sometimes like you have a group, and each angels put 100. So if they can put it individual, so it will be like a cap table of 20 or 10 angels involved, or you can create a special SPV, so special purpose vehicle, a company that will the investors will put the money in, and they will invest in the found the company as a one entity only. Simpler. This is like a straight ahead, so but there's like big cap table. Sometimes people you can invest as a personal account. Some angels has, let's say, tax optimized vehicles, so I don't know, Cyprus companies or different form of the tax optimization. Then of course the issue is you have number of angels in the cap table involved, so there's like 20 angels. For example, if you have a shareholder meeting, you have to contact 20 angels, they should come, or at least you need to wait some time before formally. More difficult at the stage, at some stages. Here it's like one day, one vehicle, and angels own shares in these SPV, so they for example, shares or rights depending on the form of the SPV. So they like basically say, okay, so let the company grow, then we will take out of the money back into the business. Somehow this form also enables earlier exits to some angels because they can sell shares in this group SPV if they need to cash out earlier, so they just not stick to the company exit. They could do it a little bit earlier. Also, one of the problems here, I would say, is if you have angels own shares in the SPV, they have to create special rules and about managing this SPV. And I believe the lead angel should be kind of a CEO or just kind of someone who will be responsible for this aspect.
So is that then still private investments?
Yeah, it will count because basically you negotiate with the angels. The angels are involved. You get this is like a very formal aspect. It's not even defined because this group SPV will be this special purpose. It will be created to invest only in this one entity. It's not a fund that will invest in 10 companies. It's only this one, and it's just a form of investment.
Mm-hmm.
Yeah. So I would say it's an angel investment. Of course, for example, for tax incentive reasons, this would be more troublesome then. Yeah, but it depends on the stuff. It could be done. They sometimes use trust vehicles. They trust entities. A different aspect that they can use.
Also because it's a complete different form of risk management there.
Yes.
As compared to single angels.
Well, individual angels do direct angel investment, so angels going direct to the company, and here it's just.
Yes, each of them has their own risk, and there the risk is shared.
No, because this is not okay. Individual angels means it's direct. Sorry, it would be perhaps better to say it's a direct investment. It's not a solo angel. Yeah. So he said we have a.
No, I understood that. No.
But the risk are very similar at the end of the day. Because the risk is like.
I don't really know because when you have individual angels or a group of individual angels investing, they are single contracts. Each of them has a single contract. Whereas in the group SPV, you have one contract per SPV, I think. And then amongst them, they offer.
Yes, of course. But basically, I would say, basically here, if you have 10 angels, or basically if we have multiple investors, we sign one contract. There's one contract signed by 10 investors.
Okay.
Because otherwise it would be like completely mess.
Yeah.
If you sign 10 contracts with different angels, we'll never find a way to proceed with the deal because then someone will have a contracting vehicles. And I believe that angels should have a very the same rights. Yes. But then, for example, if you're going in the individual angels aspect, is if you make a drug. If you want to make a drug, then you have to discuss, how many, if it's one angel enough to use a drug, if the drug will be for all angels or only for founders. For example, it has to be a majority of angels. It's getting in more and more complex aspects. Mm-hmm. And so group, for example, say, okay, we have to vote it. Yeah, simply, if you want to use the drug, let's make a vote. 60% wants the drug, we are selling our shares. But of course, then, for example, in the group if you don't want to exit the company, it's more difficult because if they exit, you should then figure out should we buy it somehow. It's not as easy. It's not as easy as it is. Pluses and minuses. Yes, it's like always balance. Have to find the balance. But basically, I would like to be as a shareholder, for example, to have 20 angels involved on my cap table because it would be also could end up would be a little bit mess on the next negotiation of next round. There's also supporting if you have negotiation next rounds, you have contacting one angel. And sometimes, even if you have, in this case, even if you have lead angel involved, at the end of the day, each individual has to sign the contract. So if he doesn't like it, well, we have a problem. Right? So this is like, this somehow simplify the group dynamics because this is a majority. It's enough. Here you need to find out that everybody is agreed to the next rounds and or contract or sign set of obligations. Especially in VC will say, I want angels to sign something, and one angel say no, then that's the case.